Welcome, everybody, to another edition of Capital Conversations. I'm Colin Day, Certified Financial Planner Professional. With me today, Mr. Ryan Potts and Mr. Joe Anderson, our two portfolio managers. Ryan, Joe, how the heck are you today?
Doing pretty well. Pretty well. Appreciate you having us on here, Colin.
Hey, it's a new year. I'm excited.
Chiefs are in the playoffs.
They are. That's a big thing. That's all I can think about right now.
It was cool that you guys decided to join my Cleveland Browns in the playoffs this year. So, congratulations to you all, I guess. But today we're not going to talk football as much as we might want to. What we're going to talk about today is a little bit of a recap of 2023 from a market perspective, but then also looking forward to 2024, what we think maybe some opportunities are, or maybe some interesting storylines that we as a firm might be interested in, and maybe how that might, how we handle our client accounts and how we work with individuals. So, Joe, we'll start with you. When you think about the year 2023, major themes, big storylines, things that you think are interesting that we should recap and bring all of our viewers and listeners up to speed on. What do you got for us?
Yeah, well, a lot of stuff happened in 2023. A lot of chaos, a lot of volatility. It was really a fun year and a tough year for a lot of investment managers. We saw a lot of big swings in the market. We saw a great fourth quarter rally that made all the numbers look really good at the end of the year. So just for some raw numbers, the S&P 500 was up about 26%. The Dow was up about 16%. We didn't see nearly as much growth in terms of the international and the emerging markets. The aggregate bond market was trending down for the third year in a row until the last quarter. Before the last 2 years, it had never been down back-to-back years. So the bond market really kind of settled out. We've got quite a few topics to really touch on here. But at the end of the day, it was a pretty good year. It was a lot of rebound from the end of last year. If you look at the last 2 years, however, the markets are flat or down, depending on which ones you're looking at. We're not necessarily out of the woods yet. We came into the 2023, and the majority of people on the street did, that recession was relatively imminent. All the major historical indicators were pointing towards it, but we haven't seen it yet.
Right.
Doesn't mean we're out of the woods. Historically, it happens about 7 quarters after most of those indicators trigger. And we're in current quarter number 7 right now.
Oh, really?
So
interesting.
Ryan, you want to talk about the Magnificent Seven? And
Yeah, just to piggyback really quick, too, on the volatility and everything. I mean, entering 2023, everyone was expecting recession, slowdown in the economy. It never came, and the story kind of played out throughout the year. And, we saw the regional bank crisis in March, and you saw kind of interest rates fluctuate quite a bit in the second half of the year. And you saw a peak in the 10-year in October at 5%, and really that rally in the fourth quarter had a lot of correlation to interest rates and really what they did and the market expectations. So, like Joe said, it was a volatile year and tough to forecast, as it always is, which is why we tend to lean towards the long game with our clients and make sure that, hey, we're helping you stay invested for the long term and meet your financial goals. But the Mag 7 really carried the market last year. By the Magnificent 7, we're talking about the 7 largest stocks within the S&P 500. They really accounted for the majority of earnings growth and much of the appreciation that we saw in the S&P 500. I know we talked about it this morning, but the S&P was up 26%. The rest of the Mag 7 was up close to 75%. The rest of the market was only up 10%. So if you account for the 10% the rest of the market did, the Mag 7 kind of carried the market in terms of about 16-17% of the return. So
yeah, and if you were to maybe clarify just for the listeners, the Magnificent Seven, who are they?
Yes.
And what is the theme behind the industry sector that they might be concentrated in?
Absolutely, and I'm going to pass this really quickly.
So the Magnificent Seven was originally the FANG, Facebook, Apple, Amazon, Netflix and Google.
Yeah.
They've added in Tesla, which I don't know if that's still in, if they removed it. They added in NVIDIA and Microsoft. Microsoft is one of the top 2 or 3 biggest companies now in the world. And it really just kind of bloomed into basically big tech.
Yeah.
So it's the largest companies that I'm sure you all know about, and they've done great. They've done fantastic. We're a little concerned with kind of the valuations on them now, Colin. Actually, they're trading at the highest valuation since the tech bubble. Obviously, Apple and Microsoft are in totally different scenarios than they were back in 2000, where they weren't making money. Now Apple's got $200 billion in cash just sitting there that they can use at any point. But they're definitely very expensive. And kind of continue on that subject, we saw the biggest growth versus value return spread of almost 35%. And that was mainly due to the Magnificent Seven, which are all classified as growth stocks.
Yeah, right. And I would say that if we expanded I know this is a 2023 recap that we're talking about right now, but if we were to go back just another 12 months beyond that to the beginning of 2022, and if we were to maybe give more context to the growth in 2023, how would have those same seven, or let's call it the S&P 500, would have performed over the year 2022 when we compare it to a good year like 2023?
Yeah, so actually in 2022, it was mostly the exact opposite. I believe
Yeah.
value stocks were down about 7%, the Russell 1000 value, where the Magnificent Seven and the NASDAQ were both down over 33%, the Magnificent Seven closer to 40.
Right.
So you
Right.
definitely see bigger swings when you only have 7 companies all in the same field there. So another reason why diversification is key.
Right, and like Ryan was talking about this morning. I mean, it's that concentration fact that hey, as the seven go, so does at least the U.S. stock market, right? So I mean, so much of the earnings are just based on those seven, where the other, what do we call that? The 493, the rest of the 493 were growing at about a 10% clip last year. So it's really important to understand not just the fact that, hey, this is why we preach diversification in our accounts, but also to smooth out that volatility so that we feel like we're focusing more on the plan. We're focusing more on the ability to meet our goals based on the portfolio allocations that we've discussed with clients in the past, as opposed to saying, all right, we're just going to shove ourselves into something else that might be the hot ticket at the time. What about internationally? What do we see internationally, guys, in regards to when we think about a big economy like China or more developed Western Europe countries? Where do we think we fell on the international side?
Yeah, I'll take that one. I think international has been a very interesting story. Again, thinking long term here, over the last 2 decades, it's lagged the market predominantly. I know a lot of advisors have kind of this home bias where a lot of advisors that I've talked to outside of our firm are actually cutting internationals out of their portfolios. We saw that same story continue last year. Internationals lagged the S&P 500 and really all domestic markets. That's why, at Correct Capital, Joe and I, we typically focus on the highest of quality companies in those markets. What I mean by quality is really we're just looking at companies that have high profitability, strong balance sheets, strong valuations. And predominantly those companies have fared much better than the rest of the markets. But you see like China last year, there was basically a credit crunch within their real estate market and a lot of slowdown within their economy. And so, if you look back to 2022 and 2021, you did see a lot of, I hate to use the word hype, but a lot of hype around China and a lot of people kind of flooding that market. We've always been on kind of the skeptical side of that, and we remain, positioned that way going forward as well.
Sure. Okay.
Yeah, and to piggyback on what's going on with China, with the one-child policy they've had for so long, the Census Bureau, the World Census Bureau, is expecting their population to be down to 800 million. They're about 1.3 billion right now by 2100. The closest kind of example you can look at in history for that would be Japan, who's been basically flat. They're almost got to all-time highs from 35 years ago. So deceleration in growth and deceleration in population is definitely not a pro. We've been very light on China as a whole. However, there are a lot of other different areas in the emerging markets that look great, specifically in Latin America, where you have a lot of the population coming into out of the third world into the second world, getting access to internet, getting access to cell phones and everything else. So there's definitely opportunities out there. China, again, is one that we're going to be very leery on, probably for the foreseeable future, I would imagine, for years.
Okay, very good. Not to shift gears too much off of what we're discussing with 2023, but last thing, just to maybe do a quick recap. When we go back to March, we talk about all those regional bank failures, Silicon Valley Bank amongst others. That story, at least from what I read, and I think all of us are pretty active participants, at least reading material in regards to how stock market economic conditions are changing over time. After, I don't know, the summer, I feel like I didn't really hear much about those banks anymore. Are there other fears? Are you hearing any other stories in regards to financial services in general as a market sector performing well, going down? What do we think as we think about overall economic conditions and more specifically on regional banks?
Yeah, I think that it's actually a really interesting story and kind of compelling. And we can look to Q4 as kind of a guide to maybe what is to come in 2024 and going forward as well. But in terms of the bank crisis that occurred in March, we think that problem was squashed in terms of the Fed came in and provided a ton of liquidity, basically saying that they're willing to bail out anybody at this point to try to save the financial market per se. A lot of those companies that did go under were terribly balanced in terms of their sheets. They had a lot of bad debt out there. And when rates were on the rise, they just weren't positioned for it, and that's essentially what broke them.
Yeah.
But really, going back to Q4 and to your point, I mean, we didn't hear about it until after May. You didn't hear about it the rest of the year. But from a valuation standpoint, from maybe a potentially attractive investment, banks look kind of interesting right now because a lot of the strong banks that are still around, that are well diversified, that have strong businesses, they continue to operate, and they are doing it at a lower multiple maybe than the rest of the market. And you kind of saw this run up in Q4 of the financials that was very compelling relative to the rest of the market. So not to say that, go dump a bunch of money into financial services right now or anything, but more or less just keep an eye on it. And I think we find it to be maybe an interesting spot going into 2024.
Okay.
And, when you have an area that's down, say, they're down somewhere around 10% in 2023, that looks a lot more attractive than something that was up 20, 30, 40% in the last year.
Right.
Silicon Valley Bank, especially the big one that everyone talks about, their biggest issue is they put a huge bet on long-term rates. So they jumped and bought a bunch of 30-year Treasury notes, which once the interest rates went up, they went down 20, 30, 40%. And then people found out and a liquidity run happened. Really a lot of just mismanagement in terms of the risk management teams at the few banks who did have a lot of trouble. But we don't see that continuing to be systemic. We don't think it's going to continue to go forward. And we think that the valuations on a lot of those banks are very cheap because a lot of people haven't still realized that, hey, U.S. Bank is still going to be doing just fine.
Okay, very good. Well, let's shift to 2024. All right, so Joe, maybe we'll start with you. So you got a lot of bullet points here. But let's think about maybe the storylines that we'll be following maybe next 3-6 months. Anything of interest? Of course, there's things that are interesting. What are the things that are interesting you the most when we think about maybe the short term in 2024? What are some of the things that you're looking out for?
Shorter term, actually today, Bitcoin launched their first ETFs from 11 different ETFs, which is a big change, a long time coming. Don't want to get too far into the weeds with it, but definitely something that we're going to be watching, seeing how money flows in and out, see how people access it. Definitely be very interesting to keep an eye on. Our biggest thing that we want to keep an eye on is pretty much inflation. We want to see how that's going to end up over the next quarter or two and how the Fed reacts. Towards the end of the year, obviously, we've got a presidential election, which can really kind of move what does well in the market depending on different policies and everything else. So we'll be watching that as we get a little closer, probably towards June or July, once we have a little more firm understanding of where everything sits. Other than that, we're continuing to watch the unemployment numbers. We're continuing to watch the savings numbers for households. And really interesting is going to be earnings here in the first quarter. There's a lot of earnings that are expected, even though I think Ryan and I are both a little more conservative that we don't think they might not hit the numbers. So long story short, again, the Fed and inflation is going to be the key.
Yeah.
Let me add to that just really quickly.
Sure.
I think the biggest thing in the short term for us is over the next 3 to 6 months to just interest rates, where the Fed goes with them and how fast they get to where the market thinks they're going to get. This is a big story for us kind of as we speak internally here at Correct Capital. But if you look back in 2022 or 2023, you see interest rates play a big factor on the way that the market's performed. And if you look into kind of October timeframe, August, October, you see interest rates on the rise substantially. When the 10-year peaked at 5%, we saw the market kind of bottom at that 4,100 number. And pretty much right after October 17th, interest rates fell to 3.8 and the market rallied up to 4,800. So I think for us, the way the market shifted in terms of their expectations for interest rates has led to a lot of the frothiness that we've maybe seen in the fourth quarter. If the Fed isn't able to pivot as fast as people want them to or expect them to, we could see some volatility in the market in the short term, especially if rates continue to climb the way they are.
Okay. Well, and then looking a little bit farther, we're not prognosticators here, of
Absolutely.
course. What are some of the other things that, again, because we're long-term focused investors. I think that's fair to say. I mean, most of our clients are those people that are nearing or in retirement that need the investment management help, that want to reduce the volatility over time, to smooth out the returns so that they can be consistent in their outflows, making sure that they have long-term success. When we think about that, when we think about the long-term focus, because we are worried, of course, about 2024 and how things are going to perform, considering the storylines that you both just shared. But how are we positioning our clients for success past 2024? When we think about the kinds of investments that we're putting ourselves into, as well as our clients, What do we think about maybe going a little bit farther, even to 2025, 2026, if we were to go out even further? What do we think about when we're putting together a portfolio for those clients?
I think when we're building portfolios for clients, the most important part is that we're keeping them involved in the markets long term, and that we're also focusing the portfolios around their individual goals and needs. So Joe and I have positions in the market. We have opinions on certain sectors and allocations and everything, but the long-term goal for us is to get our clients to meet their financial needs, and you do that by staying invested long-term and not panicking and potentially selling at a bottom or buying at a top. So we focus on long-term asset allocation and making sure that their portfolios are aligned with those goals. So different time frames, different risk tolerance, everything being taken into consideration.
Right. Joe, anything to add there?
It's pretty much just risk management. Stay invested. Historically, you do incredibly well. I think the stat we went over today is if you've been invested in the market for 10 years in a rolling period, everyone's made money. You've never lost money. Now, with that being said, we are really attracted in the value space. We think that they're very cheap. We're very attracted in the small cap space. They're trading historic spreads between valuation. But again, just stick with your plan. It might not beat the market or the index every year, but we want to make sure that we can take out as much of the peaks and valleys in our clients by being well diversified.
Yeah. Okay. Well, I think that is a great place to end this particular podcast. So, gentlemen, thank you so much for joining us. Ryan, Joe.
Thank you, Colin.
Well, we'll of course have you guys on probably at some point in the future, I think. But I appreciate you all watching or listening to this, however you are digesting Capital Conversations. And until next time, take care.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.